In funded pension systems, that is, mostly in the second and third pillar, pension savings made in the form of contributions are invested into assets. Different types of assets are available for this purpose: bonds, stocks, real estate investment, and so on. The first important question in this part of the course is therefore, how should pension savings be invested? What are typical asset classes used here? The asset classes differ both regarding their expected return and regarding the risk associated with them. Does a higher expected return always require more risk? Or are there opportunities to achieve a higher return without taking more risk? And last but not least, we turn our attention to the issue of diversification, which means dividing one's investments across different asset classes, products, and in the field of pension finance, also different pillars. How does this work best? What are the opportunities there? To answer the question which asset classes are typically used to invest pension savings, that is, where investments are made, and how funds are distributed across asset classes, we consider the asset allocation of Swiss pension funds in the year 2016. About 1/3 of Swiss pension funds' total assets in the year 2016 were in bonds. Bonds are debt securities issued by governments and also by large companies. About 1/3 of the assets were in stocks. Stocks carry typically higher risks than bonds, but also yielded a higher return on average in the long run. Between 20 and 25% of the assets were invested in real estate. Real estate is usually considered a very long-term investment with a relatively low risk. About 5% of Swiss pension funds' assets were so-called alternative investments. This is a collective category for different assets, most of which carry higher risks compared to the asset classes mentioned above, but also offer higher expected returns. The rest, again about 5%, was held in cash. What do we mean by risk when speaking about investments? This can be visualized by looking at returns, that is, the relative increase or decrease in value over time. A risk-free investment, here shown in yellow, yields a constant return each year, which is known in advance. There are no surprises, neither positive nor negative. A risky investment, on the contrary, like an investment into stocks, might have a large positive return in the first year, followed by a loss in the second year, and a positive return in the third year, which is lower than in the first year. In the fourth year, again, a positive return. In the fifth year, a loss, etc. The main point is that for a risky investment, the returns are not known in advance. The larger the fluctuations in returns over successive periods, the larger these fluctuations, the higher the risk of the corresponding investment. If an investor chooses low-risk assets, his wealth might develop as shown here. We are interested in his wealth at a certain point in time t. This could be the time when he retires. For a risk-free or a low-risk investment, the future wealth at time t is known already today with high certainty. This is different for riskier investments. For those, wealth develops in a less predictable manner. Periods of sharp increases in wealth are followed by periods of losses, and the red path here is just one out of many possible developments for such a risky investment. A different possible path, which is less positive for the investor, is shown here. We see that the investor might even end up with less wealth compared to the risk-free or low-risk investment. The main point is we do not know in advance the level of wealth at time t. The riskier the chosen investment, the larger the span of possible wealth levels at time t. For example, when entering retirement. So, why would anybody want to go for risky investments when saving for retirement if risky investments have the disadvantage that the resulting wealth is not known in advance? The reason for this is easily explained. In financial markets, taking higher risks is rewarded in the form of a premium. That is, investments with higher risks on average also have higher returns. To illustrate this, it is useful to draw a graph where asset classes are shown with their average return and the associated risk. At the bottom left, with low average returns, but also low risk, there are government bonds. Stocks have a higher risk, but also a higher average return. At the upper end of the spectrum, that is, with typically high risk and also high average return, we have certain types of alternative investments. Does it make sense to invest all the wealth into one asset class, the one whose risk-return profile best matches one's taste? No, it is always better to diversify across different asset classes to reduce risk. This allows you to benefit from the so-called diversification effect. We have illustrated the diversification effect in this graph. We start from two risky investments, one shown in red and the other one in green. The green investment goes up in the first year, while the red investment slightly loses in value during this period. Since the gain on the green investment is higher than the loss on the red one, there is an overall gain. The total wealth consisting of the red and the green investment is shown here in blue. In the second year, the green investment shows a loss in value, while the value of the red investment rises. The net effect is slightly negative. What does diversification mean? Diversification means that the combined fluctuations of total wealth, shown here in blue, are lower than the fluctuations we see for the individual investments, shown here in green and red. Ideally, the investor should select a portfolio that combines the available asset classes so that the portfolio best matches the investor's expectations. Pension institutions usually delegate this task to professional asset managers. In case of voluntarily saving for retirement, seeking professional investment advice is also recommended.